Assalamualaikum warahmatullahi wabarakatuh, and hello everyone. My name is Nuraina Nazifa binti Muhammad Daud. I'm from class B in 2792A. In today's presentation, I will be talking about financial risk in Islamic finance, which is a core element discussed in chapter 8 of our subject. Financial risk refers to the possibility of loss in financial transactions. It involves uncertainty that can affect a bank's performance and stability. In Islamic banking, financial risk must be managed according to Sharia. This means avoiding riba or interest as well as qaha, which is excessive uncertainty, and maisir or gambling. Islamic banks also cannot use conventional interest-based risk management tools. Although Islamic banks follow different principles, they still face similar financial risks as conventional banks. That's why they need risk management that is ethical, transparent, and Sharia compliance to ensure fairness, discipline, and protection from all parties involved. Now, let us move on to the core part of this presentation: type of financial risk faced by Islamic financial institutions. Just like conventional banks, Islamic banks are not immune to risk. However, the way they manage and structure their contract is different, as it must comply with Sharia rules. Let's explore the main category of financial risk in Islamic finance. The first and most common type is credit risk. This occurs when a customer who receives financing from the bank fails to make payments as agreed. For example, in a murabahah contract, the bank sells a product to the customer on deferred payment term. If the customer defaults, the bank will suffer a loss. Secondly, market risk, which relates to the changes in market price, exchange rate, or profit rates. For instance, in equity-based contract like mudarabah or musyarakah, if the value of an investment drops, the expected profit may not materialize. Since Islamic banks share profit and losses with the investor, this becomes a risk that affects both parties. Next is liquidity risk. This happens when a bank cannot meet its short-term financial obligations, such as paying depositors who want to withdraw their fund. Islamic banks may face more liquidity challenges because many Sharia compliance assets are not easily sold in the market. In addition, they cannot rely on conventional overnight lending due to interest-based structure. Another important category is operational risk. This refers to the risk of loss due to human error, system failure, or internal fraud. For example, if a mistake is made in processing a mudarabah contract, or if the wrong terms are applied to a tawarruk transaction, it can result in financial and reputational damage. That's why Islamic bank need strong internal control and Sharia compliance standard operating procedure. And for the last, there is a unique risk that only applies to Islamic bank, and that is Sharia non-compliance risk. If a financial product or transaction is found to be against Sharia, for example, involving riba or qaha, then it becomes invalid. The bank might be required to cancel the contract, return the money to the customers, or suffer a loss. Therefore, Islamic bank have a dedicated Sharia committed to review every contract and ensure compliance at all stages of the process. So, how do Islamic bank handle financial risk without using interest-based tools? The answer lies in using Sharia compliant methods that are fair and transparent. There are few important strategies they use to manage this risk. To manage financial risk, Islamic bank use several simple but effective methods. These methods follow Islamic rules and help protect both the bank and the customer. First, Islamic bank use special contracts like murabahah and ijarah. These contracts are made in a way that avoid interest and allows the bank to give financing in a fair way. Next, they use risk-sharing contracts such as mudarabah and musyarakah. In this contract, both the bank and the customer share profit or losses. This helps reduce the risk for both sides and put a trust. However, Islamic bank follow a rule that called capital adequacy ratio based on Basel III. This means the bank must keep enough money aside to cover any possible losses. It helps the bank stay strong and safe. Also, Islamic banks prepare special savings like the profit equalization reserve and the investment risk reserve. These are used to make sure customers still get stable profits even when the market is not doing well. Lastly, before making any investment or financing decision, the bank does a full check called due diligence and Sharia screening. This helps them avoid high risk or non-Islamic activities. In short, Islamic bank use this strategy to manage risk in a way that is safe, fair, and follow Islamic value. To conclude, financial risk is an unavoidable element in any banking or financial system, whether it is conventional or Islamic. Banks operate in a dynamic environment where they face uncertainties such as credit, default, market volatility, and operational failure. However, what makes Islamic finance unique is that it manages this risk within a framework of ethics and Sharia principle. Rather than shifting all the risk to one party, Islamic finance promotes fairness through profit and loss sharing, accept bank transactions, and prohibit activities like riba and speculations. The commitment to Sharia compliance adds another layer of discipline and responsibility. For instance, every Islamic bank must have a Sharia supervisory committee to review and approve contracts to avoid violations. This helps to protect not just the institutions, but also its customer and the wider community. In short, financial risk exists, but Islamic finance provides a responsible, fair, and faith-based way to deal with them.